Okay, I'll just share my screen. My screen is visible, right? Yeah. Yes. So, yeah, so good evening, everyone. Good evening once again. So, today, in this uh, in this part of Jargon Buster Webinar Series, we're actually discussing a very common issue what every founder might have faced in their entrepreneurial journey. That's mainly understanding the difference between profitability and cash flow. Because whichever founder I have spoken, like majority of them don't understand the difference between cash flow and profitability. Like often I hear from founders the common comment that like my business is in profit, but I don't have money in my bank account. This is a typical statement which I hear from a lot of founders. So today we are going to like kind of understand what is the difference between profitability and what is the difference between cash flow. Okay, so this will be more of a kind of a practical perspective. I'll be taking few example of few expenses and few items which would be specifically affecting profitability but not affecting cash flow, and few items which would be affecting cash flow but not affecting the profitability. Okay, so if you guys are ready, like just type in the chat box if you guys are ready. Yeah, okay. So, so firstly, like kind of the statement what I told, profit is not always cash. Okay, so many founders always like the statement which I told in the opening note. We are profitable but always short of cash. So that's a very common issue to be addressed because founders typically tend to understand uh, cash as a profit element. Okay, so I mean, but today we are going to try understand like kind of why profit is not always cash. Okay, so like if we look at growing companies which are like scaling up exponentially, they're having a good number of customer base, they're having good profitability, but eventually they may also fail due to cash flow issues. Okay. Also, like these are few facts which I have noted. Like 82% of SMEs failures are due to cash flow issues. Of the 100%, I mean, of the whatever percentage SMEs fail, 82% is due to cash flow issues. And again, like cash flow management is a leadership discipline, not just accounting. So if you look, maybe profitability is an accounting outcome, but cash flow management is not an accounting outcome. That depends a lot on discipline and how you manage the cash. Look, so that's why it is called as a leadership discipline and not just accounting. Okay, now let us go to the definition. What is profit? What is cash flow? Okay. So firstly, like we will look at profitability. The concept profitability, it means income minus expenses. So whatever income you have, from that you reduce your expense, you will get the profit. The typical profit and loss statement which your chartered accountant or your accountant gives you every month or at the end of the financial year. What is it based on? It's based on accrual basis. So when I say accrual basis, due entries are booked in the profit and loss statement. For example, there is rent for this month. Okay, today is 31st. Well, so the rent for October, we will be entering in the tally or in the accounting software, Zoho, whichever we are using. We'll be booking it as an expense on 31st itself, today. So typically what we do is like we create a ledger and account. Maybe it's something kind of rent account that are to rent payable. I'm not going too much into the accounting part, debit credit and all, but just telling. So on 31st, the accountant would be posting the entry that rent account is due or rent is due. But the actual payment will be happening only on 10th of November. Okay. So imagine a scenario. This will be in most of the case, it will be like this only. So October full month rent, we are booking in this month because when you take the profitability, that rent is the expense for this month. But when you need to take the payment should be made only on 10th of next month. So that is why we are telling profit is on accrual basis. Whenever an entry becomes due, we book that entry. On the other hand, cash flow means it's the actual inflow or outflow of money. So if there is typically cash coming in or cash going out of your business, that is cash flow. And it is based on cash basis. But the difference between due basis and cash basis or accrual basis and cash basis is that accrual basis is based on the timing and due basis. Cash is actual movement of cash. So if you look at the cash flow statement, rent payment will be coming only on 10th of November. It will not be coming on 31st October. Why? Because the cash movement happens on 10th of November. Okay. A classic example for this particular concept would be you sell goods worth rupees 10 lakh today. Okay. Payment you will receive from the customer only in 60 days. Profit is recorded now, cash comes later, which means that when you are selling goods worth 10 lakh rupees today, you are generating an invoice which will be given to the customer. So what happens to your P&L account? Income increases, which means that your profit will be increasing. But when the customer is going to pay you money, they'll be paying you only after 60 days. So even if you make 10 lakhs worth profit this month, you will not be having any cash at the end of the month. Why? Because the customer is yet to make the payment. So that is the difference. So in P&L, we'll be showing that as an income, but in your cash flow, this entry will be coming only after 60 days. Okay. I hope the difference is clear. So profit is income minus expense. It is booked based on accrual basis. Cash flow is actual inflow or outflow of money. It is based on cash basis. Okay. Now, profit and loss versus cash movement. So like I've told, I've taken few entries which are part of profit, which are part of cash flow. I mean, part of profit not included in cash flow, part of cash flow not included in profit. Okay. For example, credit sale, the example which we told right now. Okay. So if you're giving a credit sale to a to a customer today of say 50 lakhs or whatever it is, that becomes part of your profit or that becomes part of your P&L. But that doesn't become part of your cash flow because payment happens only after few days. Depreciation, like if you look at your audited financial statements, there is always an entry called depreciation. So this depreciation is actually a non-cash item. You are not paying the depreciation amount to anyone. Why you are booking depreciation is because you have already bought an asset. That asset you have treated as an asset. I mean, it's not, you haven't captured any expense on the P&L. So there is a wear and tear happening for the asset. That is why we are accounting a portion to the P&L. Okay. So depreciation is included in the profitability statement, but it's not a cash expense. Then accrued income, like maybe like kind of, for example, your interest income or something becomes due. Like so that we will be showing in the P&L, but again will be realized only when we receive the actual money. Also, like profit can also include your rent or the monthly payment, which we book this month, but the actual payment happens only in the next month. Okay. Now, if you go to cash flow, loan repayments are a part of cash flow, but loan repayment does not come in your profit and loss account. In your profit and loss account, only income and expense will be elements. So loan and assets and liabilities are never part of profit and loss statement. So if you're told you are repaying a loan, for example, you made uh, 10 lakh rupee profit this month. When I say profit, it is actual cash flow also. Like everything is cash based. You give an invoice, you got the money same day. You book the rent today, you pay the rent also same day. Everything you have done same day. In that case, you will be having 10 lakh in your hand. But that month you need to make another 10 lakhs of loan repayment. Okay. So you're making that loan repayment to the bank. So what happens? Your cash balance becomes zero. But still your profitability is what? 10 lakh rupees. That is it. So loan repayments are part of cash flow, but not included in profitability. Then advance payment. If you're making any advance payment to your customer, I mean to your supplier or to your vendor, whoever it is, that expense will be booking only in subsequent months. But currently there is a cash outflow. Okay. Same case, you see that 10 lakh example itself. Instead of paying the loan, repaying the loan, you are making an advance payment to your supplier. So what happened? Neither that expense is booked in your P&L, thereby reducing your profit. That is not happening. But again, you are paying 10 lakh to the customer, I mean, your supplier. So what happens? You're left with no cash, but your profitability is still 10 lakh itself. Okay. Then capex purchase, like we told earlier, uh, the kind of, I mean, asset purchase, like you're building a building, or you're creating a machinery, you're constructing a machinery, you're buying a machinery, or maybe like kind of you are buying some furnitures. All these are capex purchases. These elements also are not part of your cash flow. Then tax payments. Again, I mean, tax payments can be part of profitability also. But if at all, like kind of, there are pending tax liabilities related to previous year or something, those payments may not be part of cash flow. Sorry, profitability. Okay. Then we can look at another practical scenario: same profit, different cash. Okay. So there are two companies, company A and company B. The sales of company A is completely in cash. They do a sale of 1 crore rupees. So when I say cash, it doesn't mean the physical cash itself. It can be either to bank also. But why we are telling cash is because you are realizing the money that moment itself. That is why we are terming it as cash. It doesn't mean the cash. Okay. Now, what happens is 1 crore is the cash the company A has. I mean, 1 crore is the sale that company A and B both have done. For A, it is complete in cash. Okay, so A has received 1 crore rupees. Their expense is 90 lakh rupees. Okay, so what is the profit? 10 lakh. And eventually, what is the cash in hand? 10 lakh rupees. The example which I told you earlier. So it is in cash, expenses are in cash. So you have a profit of 10 lakh and the cash in hand is 10 lakh. What about company B? They have also done 1 crore sale, but 40% is credit, which means that they received only 60 lakh rupees. Okay, 40% is credit, so 60% only they realize. So they are getting 60 lakhs rupees in their bank account. Again, they have to pay 90 lakhs of expense. Okay, so they are paying 90 lakhs of expense. What happens if you look at the profitability? It is 1 crore minus 9 lakhs, it is 10 lakh itself. But what is the actual cash in hand for company B? It is minus 30 lakh because they got only 60 lakhs and they have to pay 90 lakhs now. Okay, both are profitable, only one has money to pay salaries. Just see this example. This is actually a very classic example of like how profitability is not related to cash flow. Okay. Does anyone have any doubt till now? If at all you have any doubt, you can share your question in the chat box or you can raise your hand. We'll be unmuting you. Okay, fine. Then we'll move to the next slide. Sources and uses of cash. Okay. So, what are the sources of cash and why we are using cash? I mean, okay. So these elements are part of cash flow components. So whenever you get a customer receipt, or whenever you get a loan, or you get an investment, or whenever you sell an asset, that is the only time when you get a cash into your business. Okay. Not when you do a sale. When you do a sale, you never get I mean, you may not be getting the cash because there will be a credit period. Okay. Or maybe like kind of you're raising a service invoice to a customer. In that case, also you will not be receiving cash. Cash may be received only later. There are only these. If you look at these column sources of cash, only these ways cash will be coming into your business. One is by customer receipt. The other is loan, investment, and asset sales. Okay. So these are the ways in which cash will be coming into your business. Then what all are the uses of cash, or how do cash go out of business? When you pay to your supplier, when you pay to your employee, when you do tax payment, when you do loan repayment, when you buy an asset, capex, or when you distribute dividend. These are the ways in which you spend your cash. So payment to suppliers, again, if the supplier gives you an invoice, okay, that doesn't mean that cash is going out of your business. Okay. So if at all a customer supplier give you an invoice, that doesn't mean that cash is going out of your business. It just means that your profit is going to reduce. But when you make the payment, cash really goes out of your business. And again, same is the case with employees. So 31st of every month, you will be running your payroll, you will be booking salary expense. But for example, your salary date is first of next month. Typically, the cash movement happens only on the next day. That day it doesn't happen. Okay. So I think this part is also clear. Sources and uses of cash. So I'm moving to the next slide. So what are the common cash flow pillars? These are something what you need to know mainly. Okay. So one is delayed collection. So for example, you have raised the invoice today. The customer is not doing payment. Neither your finance team or accounts team is also not interested in following up and collecting the payment. That is going to be a cash flow pillar. So there should be there should be proper terms and conditions with all your customer. What is the payment terms? Whenever one day elapses, you should be calling the customer. There should be rigorous follow-up. So the moment you kind of increase the cash collection rate, the more you can do the business. This typically happens in trading business. For example, in trading, you ideally need cash to buy uh, goods also. In few cases, it is like you have good demand for your product. But what happens is you are not having money to purchase the product. So there can be instance like that. For that, you need to speed up the collection. Okay, so delayed collection is a cash flow killer. Then excess inventory. So excess inventory, again, the problem is that if you buy excess inventory, that won't be affecting your profitability. Because if you look at the gross profit, it is not what the sales minus cost of goods sold. What is cost of goods sold? Opening stock plus purchases plus direct expense minus closing stock. So your stock and all those things get adjusted there. So for example, uh, you're having 10 lakhs of opening stock, but your closing stock becomes 1 crore. Okay. And you did what? 2 crore revenue you did, and you purchased around, again, 2 crore of inventory, or maybe 1 crore of inventory. Okay. So what, sorry, you purchased around, say, what, again, 2 crore of inventory. So what happens is, what is your cost of goods sold? This opening stock plus purchase. What is your opening stock? It is uh, 10 lakh rupees. Purchase is 2 crore, 2.1 crore, minus 90 lakhs. 90 lakhs is your, minus 1 crore. 1 crore is the closing inventory. So it is 1.1 crore is the cost of goods sold. What is your sale? 2 crore. You made a profit of 90 lakh rupees. Okay. But ideally, that 90 lakhs you would have deployed excess in your inventory. Okay. That 90 lakh rupees, you have made profit, but still 90 lakhs, 1 crore rupees is stuck in your inventory. I mean, if the inventory increases to say 1.1 crore, you would have purchased for 2.1 crore. So what happens is for the purchase, you are paying the cash outside of your business. But from a profitability angle, you are minusing the closing stock. So typically, it does not affect the profitability. But when you're purchasing, you are sending cash out of the business. So what happens is whenever you are having an excess inventory, that is going to affect your cash flow badly. Okay, that is another cash flow killer. Then high overheads. I needn't tell about those things. Whenever the expenses are high on a higher side, uh, again it's going to affect your cash flow very badly. Because typically, what happens in businesses is that uh, only in trading business we have credit terms for our expenses. Okay, but if you look at all the other overheads, be it salary, be it rent, or be it any consultant expense, or be it any loan EMI or anything, there is no credit period. You'll have to pay it off immediately. But the sale, what you're doing, there is a credit period. So that is why you need to reduce the overheads. Okay. Then unplanned capex. For example, uh, I mean, all of a sudden, you need to buy some uh, asset. some air conditioner or something, because you know that it is going to be summer this month, not this month, but whatever month it may be. So you would be requiring an AC. So you should be planning such things in well and advance. Okay. So when you are not planning and it is a very hot in your office and employees are not able to work properly, but you need to buy an AC now, but you don't have cash. So such things can also happen. So unplanned capex is another cash flow killer. Okay. Then again, tax surprises. That you're not updated about like what is happening with your cash. For example, every 20th of every month, your accountant would be coming and telling you, you have to pay this much amount of GST, which again you may not have planned, or maybe like kind of there will be some tax in the past which you may not have paid properly. Now the department is coming after you, telling that you need to pay this tax, which you didn't plan. So such tax surprises can also affect the cash flow. Then another thing is founder withdrawal. When the founder excessively withdraws cash from the business, that is also going to affect the business very badly. That is also another common cash flow killer. Okay. Now, managing cash flow effectively. So this is another important thing what everybody should be following. So there are three pillars of cash flow management. One is forecasting, second is discipline, and third is visibility. Okay. Forecasting is like, you need to have a weekly, monthly projections. Like this week, how is your cash collections going to be? This week, how is your cash payments going to be? What is the shortage that you are expecting, or what is the excess that you are expecting? And you need to plan for that accordingly. So forecasting is a very important thing. Then discipline. Invoice early, collect fast. So for example, if you can invoice, so today is a Friday. Like let me take an example of a service industry or a service office like mine. Uh, I'm not working on Saturday, Sundays. My office is on leave. So if at all I invoice an invoice today, the chance of my collection of that amount tomorrow would be high. Maybe my client is working on Saturday, so they will release the payment on Saturday. But what if we are not that disciplined? We are not that aggressive. So my accountant comes and bills the invoice on Monday evening. What happens? I'll be the next day, Tuesday morning or afternoon, maybe like they'll be seeing the invoice and they'll be sending for processing, and I'll be getting the amount only on Wednesday. But if had I done the invoicing today, I would have got the money tomorrow, and Monday when my accountant comes back, he'll be seeing the credit and he can use that money for the expenses for that week. Okay, so discipline is very important. You should be invoicing early, and then you should be collecting the money also faster. Then visibility, dashboards, MIS report, all these things are very important because you need to have a visibility of how your business is progressing. What is your futuristic sales, or what is the cash that you have collected during the month? What is the cash that you have paid during the month? All those dashboards and MIS reports also you should be having. So there are three pillars for cash flow management. One is forecasting, second is discipline, and the third is visibility. Okay. Now the bridge from profit to cash flow. This is a bit accounting kind of thing. I mean, if at all you have studied commerce in +1 or +2, this would have been part of your syllabus. So I'm not going deep into this, but I'll be just explaining it like this. So how we are arriving from profit and loss or profit to cash flow. Okay. So you have your profit and loss statement prepared. You have your income, you have your expense, you have your profit. This profit we are taking to the cash flow or cash flow statement. So profit becomes the first element of a cash flow statement. In P&L, profit is the last element. This profit we take to the cash flow statement. On the cash flow statement, in the cash flow statement, what we do is we add the non-cash expenses to the profit. Depreciation. Why are we adding back that? Because actually that cash has not been gone out of the business. So you need to add back the cash flow expense, cash expense. Okay. Then you need to plus or minus working capital changes. So when we say working capital changes, it is the change in receivables, payable, and inventory. So if your inventory has increased, for example, inventory has gone up from 10 lakh to 20 lakh, it means that you have spent 10 lakh rupees extra on your inventory. So that amount you have to minus from your profit. Okay. For example, your receivable has gone down from 1 crore to 50 lakhs, which means that you have received a net collection of 50 lakhs in your business. Okay. Your payable has gone down from 50 lakhs to 20 lakhs, which means that you have paid 30 lakhs to your creditors. So those things, that thing you should be reducing from the profit to arrive at the cash flow. Okay. So this is another item. After that, you need to plus or minus capex and loan movements. For example, you are buying an asset, cash is going out. You need to minus it from the profit. You get a loan from your friend, 10 lakh rupees. Cash is coming into the business. You need to add it to the profit. So that is a cash income. When you do all this exercise, you have the cash flow from operations. What is your net cash flow? How much money you have really made from the business? How much cash you have made really from the business? Okay. So it is, let us do that once again. Like, I mean, it's P&L there. You have income, you have expense, you have P&L. This is the last item here. This we take to the top of the cash flow statement. There, net profit is the first item. On the net profit, you add the non-cash expense because that expense didn't involve a cash element. The money has not gone out of the business. Okay, so you'll be adding back the cash expense. Then you will be doing plus or minus working capital changes. If the receivables increase, that means that what I mean, the receivables increase, like you have more money to get, which means that cash is going out of the business. 50 lakhs becomes 1 crore, you need to minus 50 lakh. Similarly, payable increases, which again means that uh, you're getting good cash. I mean, from 50 lakhs, your payable increases to 1 crore. That means that you haven't made cash payments to your creditors. So that cash you will be having in your business. So that you will be adding back. Again, inventory. If the inventory goes down, that means that you haven't invested much on inventory. That cash you should be having. You can add that. But if inventory increases, that means that you have spent extra amount on inventory. You will be minusing it. Then we have plus or minus capex and loan movements. So if you buy an asset, cash is going out. So you minus from the net profit. You get a loan from your friend or bank, that money is coming into the business, you add it. The net effect is what is called the cash flow from operations. Okay. So anyone have any doubt here? I know it's a bit technical, this one. Okay, so I'll move to the next slide. Oh, this is actually a case example. A startup earns 50 lakhs revenue, 8 lakh profit, but payments delayed by 60 days. Vendors and GST is due in 30 days. What my question is, like, what happens if investors delay fund by 45 days? Can anyone answer? If anyone want to answer, you can either raise your hand or you can put it in the chat box. Okay, fine. Maybe like I'll only have to answer that. So basically, what would be happening is, like, kind of after on the 30th day when you have to make GST payment and vendor payment, you'll be left with no cash, because the investor will also be paying you only on the 45 days, which is again 15 days after the 30 days. So you'll be left with a no cash situation and your business can get badly affected. Okay. So again, coming to the summary part, these are the key takeaways from this session. Profit doesn't mean or doesn't equal cash flow. Okay. Growing your business consumes a lot of cash. Okay. Because that's why asset building and all those things are part of cash flow, but not profitability. Cash flow is survival. If you have cash flow, only your business will survive. If you have profit, that doesn't mean that your business have to survive. Then you need to monitor working capital very effectively. Then forecast before you spend. Okay. So revenue is vanity, profit is sanity, cash is reality. Okay. Does anyone have any question? I mean, that's it from my end. If anyone have any question, you can ask the question. Okay. So if at all there are no questions, I think we'll wind up the session. If you want to, we'll be having bi-weekly sessions on small topics. I'll try to cover, uh, twice in every month. That is the plan. Uh, my sessions won't be more than like 30, 45 minutes plus another 10, 15 minutes for Q&A sessions. I just want to cover a few areas in a few simple way. That's all my plan is. So if at all you are interested, you can scan the QR and join the WhatsApp group so that you'll get the updates there. Okay. So thank you everyone. Thank you. Bye. Have a nice day. Good night.